James, if I just bring up the intraday graph of the Australian share market, you can see that for most of the day, we were just flatlining, down by 0.4%, but not too much action on the market. We did see selling across most sectors, though, with the exception of healthcare and the industrials, but it was in some of the defensive areas that we saw the biggest losses, areas like the consumer staples, property, as well as the telecom area. Because one of the things that we noticed on the market is that we did see risk aversion coming into play. We saw some losses in terms of gold overnight, copper prices were down, commodity prices generally lower. But one bright spot on the market has been mining services. If we have a look at just the last 5 trading sessions, there's been some huge moves on the market. Ausdrill up by 28%, we've seen NRW up by 23%, Transfield up by 15%, and Monadelphous up by 14% just in the past week. And in fact, if we have a look at the monthly gains for these stocks, even more impressive. Ausdrill up by 62% for the month, NRW up 52% for the month, Transfield up 32%, and Monadelphous up by 24%. And really what's driving this is more optimism around global growth, especially China. So a bit more life coming into this mining services, and the thought that perhaps the market has been too pessimistic given the better growth numbers that we are coming out of China. And certainly that theme continued today. We saw Downer EDI up by 4.7%, Cuba Logistics up by 3.2%, being some of the biggest movers on the market. So gold was down, but mining services, I think, was one of the brightest spots on the market.
Thoughts on, been reporting throughout the day, changes to the Macquarie model portfolio, and they're looking to less exposure in the defensive yield plays and looking to build exposure in some of the more cyclical growth, Rio being one of those, and moving away from Telstra. Look, your thoughts around the timing of this rotation?
We've been talking about this for a while, that we have seen investors adding more risk to the portfolios and getting into the cyclicals. And for 2 key reasons. One, the better outlook for global growth, and secondly, the better outlook for earnings on the ASX 200 or the Australian share market. And if we have a look at global growth, we've gotten readings around manufacturing, around services from all over the globe this week, and the numbers have showed that there is some momentum coming into key markets like the UK and like the US. So they have surprised on the upside, and so we've seen an upgrade in global growth expectations, and that's great news for sectors like the materials space and like the mining services space, areas that have been quite beaten down. Secondly, domestically here, if we have a look at the cycle, well, we're probably near the end of the interest rate cutting cycle by the RBA. And while lower interest rates are usually good news for companies who are net borrowers like us, generally, if you go back in time and crunch the numbers, the correlation between the direction of interest rates and the market are quite strong. So if the market's rising, interest rates are usually rising, and if the market's falling, interest rates are usually falling. So the fact that we are coming to the bottoming of this interest rate cycle, I think, is a positive signal for the Australian share market, but probably even more important is the earnings cycle. And of course, the last few years we've seen negative earnings growth, and the earnings cycle looks to be bottoming out, and we're going to see earnings growth in the current financial year, and that's a key driver of the share market. So while the stock market may look overvalued or a little bit expensive on historical valuations, and in terms of the PE ratio and the average that we've seen over the last few decades, if we do see earnings growth come through, then we're going to see those valuations falling. So the market anticipating that, and I think we are seeing the cyclical sectors running because of that. So 2 key reasons. One, global growth looking a lot better, and secondly, the cycles here in Australia look like they're at an inflection point as well.
The trade balance figure into the idea of particularly the miners, the growth stocks. I mean, we saw exports, nothing to write home about at all, and you want to see growth in exports because you think that's going to fuel the earnings, it's going to fuel the share prices.
Absolutely. These numbers are interesting, even though they are in the past, and they are for the month of July, because we get an insight into what's driving the Australian growth story or keeping it back. And if we have a look at expectations, it was for a $100 million surplus. Instead, we saw a deficit of $765 million. Now, if we have a look, we did see exports being flat, but we saw imports rising by 4%. And if we have a look at exports, around about 50% of Australia's exports from metals, coals, iron ore, oil, LNG. So we get a little bit of an insight into this, but the numbers, I think, coming in below expectations because of the import side of things. We've seen a growth in imports of 4%. We know that oil prices have been rising, so that's a key. And if we have a look these numbers, I guess, and look at what might be anticipated, well, we know we've been seeing some stronger growth numbers coming out of China, and China is responsible for around about 27% of our exports and about 17% of our imports. So the fact that we are seeing a better Chinese growth story means that these numbers will probably improve in the coming months. Not only that, we did see some statistics coming out of Port Hedland for iron ore exports, and these numbers were strong for the month of August. We saw a jump of 9% there. So it does look like the iron ore exports out of Port Hedland still quite strong, and that bodes well for our coming months. So while these numbers were below expectations, they were July numbers. Since then, we've seen some better numbers coming out of China, and also these Port Hedland statistics are pointing to a better number in the next couple of months.
Julia, one of the key focuses at the moment, not just for markets, more broadly, obviously the election happening in just a couple of days' time. We saw coalition costings out today. How does it translate into how you view the market, and what are the key pressure points you're looking at that you feel, I suppose, relates to the election?
Well, I guess we've seen a number of announcements now, and I guess the key one coming out of today is infrastructure spend. So that bodes well for the industrial sector. Not only that, what we usually do see is a kick up in consumer confidence as well as business confidence after we do see a majority government coming in. So if we have a look at how that translates into asset allocation and for portfolios, usually a higher consumer confidence and business confidence, great news for those cyclical areas like the consumer discretionary sector, the industrial sector, and these are the areas that have been performing well in the past months. So investors have already cottoned on to the fact that one of the things that may come after the election is another uptick in confidence. So the industrial sector up by 4.6% in the past month. We've seen the discretionary sector up by 2.3% in the past month. The other thing that we're watching is the carbon tax, and if we do see a scrapping of the carbon tax, we know that this has quite a large impact on industries like the airlines. So watching stocks like Qantas as well as Virgin for a positive impact eventually there if we do see a scrapping of the carbon tax. And of course the building material companies like Adelaide Brighton, they would see quite a significant impact as well. So that would be a positive for those industries and those type of companies in eventually if we do see a scrapping. And then the bank levy that's been talked about, and looks like that may come through. That's not going to have a material impact on the bank's profits, so probably investors can rest a little bit easier there because it will only have an impact of about 0.5% to 1%. But it does look like investors have already positioned themselves for this election result and for a coalition win. So one more trading day to go until we go to the polls, but all up, it does look like one key beneficiary is McMillan Shakespeare up another 4% today.